Listen carefully. I want you to understand something that most investors are still refusing to confront. What is happening beneath the surface of the global financial system is not a routine economic adjustment. It is not another temporary period of inflation. It is not another market correction that policymakers can solve with a few speeches, a few rate changes, or another round of monetary stimulus. What is developing right now is much larger than that. It is the gradual exposure of structural weaknesses that have been building for decades. And if you continue evaluating silver through the lens of the old monetary environment, you may completely misunderstand the magnitude of what could be coming. Most people still think silver is simply an industrial metal. They look at price charts. They compare it to stocks, they compare it to bonds, they compare it to other commodities. Then they conclude that silver has underperformed, disappointed investors, and failed to justify the expectations many people once had for it. But that conclusion ignores a much bigger reality. It ignores the conditions that allowed financial assets to dominate capital flows for so long. It ignores the unprecedented expansion of debt. It ignores the extraordinary intervention required to maintain confidence in a system increasingly dependent on artificial support. You need to understand what is happening. For decades, economic growth has become progressively more reliant on borrowing. Governments have accumulated obligations at a pace that would have seemed impossible in previous generations. Financial markets have become dependent on liquidity. Central banks have repeatedly stepped in whenever instability threatened confidence. Every cycle has required larger responses than the cycle before it. Every rescue package has become bigger. Every intervention has become more aggressive. Every attempt to maintain stability has demanded greater distortion. This is not evidence of strength. It is evidence of dependence. History has demonstrated something important again and again. Systems built upon expanding debt eventually reach a stage where maintaining stability becomes increasingly difficult. At first, the pressure remains hidden. The public sees normal market activity. Economic data appears manageable. Confidence remains intact, but beneath the surface, vulnerabilities continue expanding. Debt grows faster than productive output. Financial assets become disconnected from underlying fundamentals. Monetary authorities become trapped between competing objectives they can no longer fully satisfy. That is where the danger begins. The real issue is not whether pressure exists. The pressure is already visible. The real issue is whether investors recognize what that pressure means before the broader market does. Because by the time recognition becomes widespread, the repricing process is often already underway. Most people focus on short-term headlines. They focus on quarterly earnings. They focus on daily market fluctuations. They focus on temporary narratives that dominate financial news cycles. But structural shifts rarely announce themselves in advance. They develop quietly, they build gradually. Then eventually they emerge all at once. This is why silver deserves far more attention than it is receiving. Silver occupies a unique position within the financial system. It is simultaneously an industrial asset and a monetary asset. It participates in manufacturing technology, energy infrastructure, and industrial demand, but it also carries thousands of years of monetary history. During periods of confidence, investors tend to emphasize its industrial role. During periods of monetary uncertainty, they begin focusing on its monetary role. That distinction matters enormously. Because if confidence in the existing monetary framework begins weakening, silver is no longer evaluated solely through traditional commodity models. The entire framework surrounding valuation starts changing. Investors begin asking different questions. Institutions begin reassessing risk. Capital begins searching for durability rather than performance, and when that happens, historical assumptions lose relevance very quickly. I am not talking about speculation. I am not talking about temporary enthusiasm. I am talking about a shift in perception. History has shown that when confidence begins moving away from financial promises and toward tangible stores of value, capital flows can become extremely powerful. The process often starts quietly. Only a small number of participants notice the change. Then larger pools of capital begin repositioning. Then institutions start adjusting exposure. Eventually, public recognition follows, but public recognition is usually late. That is why so many investors fail to benefit from major monetary transitions. They wait for certainty. They wait for confirmation. They wait for headlines to validate what is already happening. By the time that confirmation arrives, A significant portion of the move has already occurred. This pattern repeats throughout financial history. At first, warnings are dismissed, then concerns are minimized, then developments become impossible to ignore. Then everyone suddenly realizes the environment has changed. What makes the current situation particularly important is the scale of the imbalances that have accumulated. Debt burdens continue expanding. Fiscal pressures continue growing. Currency purchasing power continues eroding. Governments continue relying on borrowing. Central banks remain deeply involved in maintaining financial stability. Markets continue showing increasing sensitivity to liquidity conditions. These are not isolated developments. They are connected. They are symptoms of a system operating under growing strain. Most investors still assume policymakers possess unlimited flexibility. They assume authorities can continue managing every challenge indefinitely. They assume future interventions will be just as effective as past interventions. But history suggests otherwise. There comes a point where policy tools produce diminishing results. There comes a point where additional intervention creates new problems instead of solving existing ones. There comes a point where confidence itself becomes the primary variable. And confidence is far more fragile than most people realize. Once confidence begins weakening, capital behavior changes rapidly. Investors who previously prioritized growth begin prioritizing protection. Institutions that once focused exclusively on returns begin focusing on preservation. Financial markets that once rewarded risk-taking begin rewarding resilience. This is where silver becomes increasingly important, because silver does not depend on political promises. It does not depend on central bank credibility. It does not depend on fiscal discipline. It exists outside the mechanisms responsible for many of the imbalances now visible throughout the global economy. Most people overlook that reality because they remain anchored to the assumptions of the previous era. They believe stability will continue indefinitely because stability has defined most of their investing experience. They assume the future will resemble the past because that assumption feels comfortable. But major transitions never feel obvious in the beginning. They only appear obvious after they have already occurred. And right now, the conditions that have historically preceded major monetary shifts are becoming increasingly difficult to ignore. You need to think carefully about what happens when a financial system reaches a stage where debt expansion becomes the primary mechanism sustaining economic activity. Most people assume this process can continue indefinitely because they have never experienced anything different. They have lived through decades where every crisis was met with additional liquidity, every slowdown was met with intervention, and every instability was eventually absorbed by larger policy responses. That experience creates a dangerous illusion. It creates the belief that every problem can be managed. It creates the belief that every imbalance can be postponed. It creates the belief that authorities always possess another solution. But history tells a different story. Every long-term debt cycle eventually reaches a point where maintaining confidence becomes more difficult than creating debt itself. At that stage, policymakers face increasingly difficult choices. Tightening conditions risk recession, financial stress, and asset market weakness. Loosening conditions risk accelerating currency debasement, inflationary pressure, and declining confidence in the monetary framework. Neither option is painless. Neither option is permanent. Both involve consequences. That is why late-cycle environments become so important for investors who are paying attention. The issue is not predicting the exact timing of a transition. The issue is recognizing that structural conditions are moving in a direction that makes transition increasingly likely. Most people miss this because they remain focused on surface-level developments. They watch daily market fluctuations and assume they are observing the entire picture. They focus on short-term data releases while ignoring long-term trends. They analyze symptoms while overlooking causes. But the causes matter, debt matters, purchasing power matters, fiscal sustainability matters, monetary credibility matters. These forces determine the foundation upon which every financial asset is ultimately valued. When that foundation begins weakening, the effects eventually spread throughout the entire system. This is where the concept of monetary reset becomes extremely important. A monetary reset does not necessarily mean a formal announcement. It does not require governments declaring a new currency overnight. It does not require dramatic headlines that instantly change the global financial system. In many cases, a monetary reset begins through repricing. Assets start reflecting realities that were previously ignored. Markets begin adjusting to risks that were previously discounted. Capital starts moving toward areas that offer protection from growing uncertainty. The transition may begin gradually, but once confidence shifts, momentum can become extremely powerful. That is why silver deserves attention far beyond its current valuation. Most investors evaluate silver using frameworks developed during periods when financial assets were the primary beneficiaries of monetary expansion. They assume silver must behave according to the same expectations that governed previous decades. But if the environment itself is changing, those assumptions may no longer apply. Think about what happens when investors begin questioning the durability of purchasing power. Think about what happens when preserving wealth becomes more important than maximizing returns. Think about what happens when institutions that have spent decades concentrating exposure in financial assets begin searching for alternative forms of protection. Those shifts matter because silver exists within a relative market compared to the enormous pools of global capital-seeking investment opportunities. That fact is often underestimated. People hear discussions about potential repricing and assume such outcomes require universal participation. They assume every investor must suddenly become interested in silver. They assume massive public enthusiasm is necessary before meaningful price movement can occur. That is not how constrained markets work. A relatively small reallocation of capital can produce disproportionately large effects when supply flexibility is limited. This is not a theory. It is a characteristic of market structure. When demand expands significantly faster than available supply, prices adjust. When confidence in traditional financial assets weakens while interest in tangible monetary assets increases, prices adjust. When institutions begin competing for exposure within a market that was previously ignored, prices adjust, and those adjustments are rarely linear. That is what many people fail to appreciate. Structural transitions are not smooth. They are not orderly. They are not predictable in the way conventional market models suggest. For extended periods, nothing appears to happen. Skeptics become more confident. Believers become discouraged. Public attention fades. The asset remains overlooked. Then perception changes. Once perception changes, capital flows change. Once capital flows change, valuation changes. And once valuation changes, narratives change. The same people who previously ignored it matters. Analysts revise projections. Institutions reconsider allocations. Financial media shifts focus. Public participation increases, but by then, the opportunity landscape has already changed. This is why positioning often matters more than prediction. You do not need to know the exact month the transition begins. You do not need to know the exact catalyst that triggers recognition. You only need to understand the structural conditions creating the possibility. Those conditions are visible today. Governments continue expanding debt. Deficits continue growing. Interest obligations continue increasing. Currency purchasing power continues facing pressure. Financial systems continue requiring support. And markets continue displaying extraordinary sensitivity to liquidity conditions. None of these trends suggest a return to effortless stability. They suggest increasing dependency. Dependency creates vulnerability. Vulnerability creates uncertainty. And uncertainty changes investor behavior. Most people remain psychologically attached to the assumption that the current framework can continue functioning indefinitely. They believe debt accumulation carries no meaningful limit. They believe intervention can permanently offset structural weakness. They believe confidence can always be restored through additional policy action. But confidence is not manufactured endlessly. Eventually, confidence must be earned. And when confidence becomes difficult to maintain, markets begin searching for alternatives. That search is what creates repricing events. The real question is not whether pressure exists inside the current system. The evidence is already visible. The real question is how much pressure can accumulate before investors collectively begin responding to it, because once that process accelerates, market behavior changes rapidly. Assets that spent years being ignored can suddenly become highly sought after. Assets that appeared unimportant can suddenly become strategically significant. And assets positioned at the intersection of monetary history and modern financial uncertainty can experience valuation changes that seem impossible beforehand. That is why dismissing silver simply because it has spent years frustrating investors may prove to be one of the most expensive mistakes of this cycle. The environment surrounding silver is changing. The pressures surrounding the monetary system are changing. The psychology of investors is changing. And when all three begin moving in the same direction, history suggests the results can be far more dramatic than most people are prepared to imagine. Listen carefully. The biggest mistake investors make during periods of structural change is assuming that tomorrow will operate according to the same rules that governed yesterday. They become anchored to past conditions. They become dependent on historical assumptions. They expect familiar solutions to solve increasingly unfamiliar problems. That mindset works during stable periods. It becomes dangerous during transitions. The reason is simple. Financial systems do not remain static forever. They evolve. They expand. They accumulate distortions. They absorb increasing amounts of debt and leverage. Then eventually they reach a stage where the cost of preserving the existing framework begins rising faster than the benefits that framework provides. That is when monetary reality begins asserting itself. Most people never recognize this process while it is happening. They wait until the consequences become obvious. They wait until the headlines become impossible to ignore. They wait until institutions openly acknowledge what had previously been dismissed. But markets do not reward late recognition. Markets reward preparation. And preparation begins with understanding where the pressure is building. Right now, that pressure is visible across multiple dimensions simultaneously. Fiscal obligations continue expanding. Sovereign debt continues growing. Purchasing power continues facing long-term erosion. Governments continue relying on borrowing to sustain spending. Financial markets continue depending on confidence that future intervention will remain available whenever instability emerges. These developments are not independent. They reinforce one another. Each layer of dependency creates additional vulnerability. Each intervention creates additional expectations. Each postponement creates larger imbalances. For years, the system has functioned because confidence remained sufficiently strong to support those imbalances. Investors believed future growth would justify current debt. Markets believed policymakers retained enough flexibility to manage every disruption. Institutions believed liquidity would remain abundant whenever problems emerged. But the longer those assumptions are stretched, the more fragile they become. That fragility matters because when confidence eventually begins weakening, the adjustment process rarely remains confined to a single sector. It spreads through the broader financial architecture. Risk premiums change, capital allocations change, investor priorities change, and once priorities change, valuation frameworks change as well. This is where the concept of silver repricing becomes increasingly relevant. Many people hear discussions about substantial future valuations and immediately focus on the number itself. They debate whether a particular target sounds realistic. They compare future possibilities against current prices. They evaluate outcomes through the lens of today's conditions, but that approach misses the larger point. The discussion is not fundamentally about silver. The discussion is about the monetary environment surrounding silver. If the monetary environment changes, the valuation process changes. If confidence changes, capital flows change. If capital flows change, prices change. That sequence has appeared repeatedly throughout monetary history. People often assume dramatic repricing requires dramatic events. Sometimes it does, but often the process begins through gradual recognition. Investors start noticing structural weaknesses. Institutions begin reassessing exposure. Policymakers face increasingly difficult trade-offs. Confidence begins shifting incrementally, then momentum takes over. What seemed unlikely starts appearing plausible. What seemed extreme starts appearing reasonable. What seemed impossible starts appearing inevitable. This is how perception evolves during major transitions. And perception is one of the most powerful forces in financial markets. The reason silver may become increasingly important during such an environment is because it possesses characteristics that become attractive when confidence weakens elsewhere. It is tangible, it is scarce, it cannot be expanded through policy decisions. It exists independently of the promises supporting many modern financial structures. That independence matters, especially during periods when investors begin questioning the durability of the structures surrounding them. Most people still underestimate how quickly collective psychology can change once confidence begins deteriorating. For years, markets may appear stable while underlying vulnerabilities continue accumulating. Then a catalyst emerges. It may be fiscal, it may be monetary, it may be credit-related, it may originate from a source few people anticipated. The specific catalyst is often less important than the conditions that existed beforehand. Catalysts reveal weakness. They do not create it. The weakness already exists. That is why focusing exclusively on short-term events can be misleading. The deeper story is the accumulation of structural pressure over time, and pressure inside financial systems behaves much like pressure anywhere else. It builds gradually, it remains hidden, then eventually it seeks release. The question facing investors today is whether they recognize that buildup while there is still time to position rationally. Because once broad recognition arrives, behavior changes rapidly. Investors who ignored risk begin chasing protection. Institutions that dismissed alternatives begin seeking diversification. Markets that previously rewarded complacency begin rewarding preparedness, and assets positioned as monetary hedges suddenly receive attention they lacked for years. This is not speculation, it is a recurring pattern. History demonstrates that prolonged periods of confidence often create the conditions for future instability. Stability encourages leverage. Leverage encourages risk-taking. Risk-taking encourages excess. Excess creates vulnerability. Vulnerability eventually demands adjustment. The cycle repeats because human behavior repeats. That is why understanding the larger monetary picture is so important. You are not simply evaluating a metal, you are evaluating a potential response to systemic pressure. You are evaluating how capital may behave during a period of growing uncertainty. You are evaluating what happens when preservation becomes more important than performance. And if that shift accelerates, silver could find itself at the center of a monetary repricing process far larger than most investors currently imagine. The evidence of strain is already visible, the dependency is already visible, the imbalances are already visible, the only uncertainty is timing. But timing has never been the most important question. The most important question is whether you recognize what is forming before the majority does, because once the broader public fully understands the implications of expanding debt, declining purchasing power, increasing policy constraints, and growing monetary fragility, the repricing process may already be underway. And when that recognition finally arrives, the investors who's prepared during the period of complacency will not be asking whether the transition has started. They will be watching the rest of the market realize it.